Hi there, retail investors. I'm Pradeep, Chartered Accountant by profession. Welcome to my channel. In today's video, let's discuss about the 5 common mistakes that every or most of the retail investors do commit in the stock market. Let's get started. The first and foremost mistake is misunderstanding the bull market trend. As we know, the present trend of the market is bullish, right? And retail investors do believe that such trend is there to stay for the long term. Before questioning that belief, let's understand why there is a bullish trend in the market. Take a look at this Nifty 50 trend. If you see between 2016 to 2020, the market gave an absolute return of 39%. So when that is compared to the compounded annual growth rate of PF or FT, it is much lower. So technically the market was never in bearish trend, but still it was not overperforming as the market does now. Then in 2020, due to COVID, it took a nosedive, right? It gave a sharp correction to the extent of 20% to 30%. Thereafter, the market recovered in a form of V-shaped recovery, as we all know. Any rational person, right? It looks attractive, but any rational person definitely wants to understand what is the reason behind this. As the economy is in deep trouble due to the COVID, still the economy is still under recession. Like the growth rate, though it is showing, but it is not alarmingly so well to justify the market return. The big reason for this bullish trend, though there are so many factors, but the most important factor is that quantitative easing. Quantitative easing. This is the kind of operation that Federal Reserve, that is how we have RBI in India, Federal Reserve is the central bank for US. They do conduct this operation wherein if you take a look at their balance sheet position between 2008 to 2020, their asset size, it means the money flow in the economy has risen from 2 million to 4 million, whereas in the last 1 year it has risen from 4 million to 8 million. Yes, friends, the time has gone. No money is backed by gold. All monies are called fiat money, which is printed out of thin air. In India, we call this operation with different name, as you have been seeing in the newspaper like TLTRO, repo, reverse repo. These are the operations that RBI does, through which the new money comes into the economy. How this is exactly done in India is that RBI would lend the money to the government in form of borrowings, as well as to bankers, that is commercial bankers. And this government has to repay that money along with interest, and they source this money from the citizen by way of collecting tax, and the bankers does by collecting interest. Bankers do book a profit, that is the interest that they pay to the RBI, and the interest that they collect from you is their margin. So this is how the market works. But quantitative easing takes one step forward. That is, in US what they do is they print the money and they directly transfer that money to the pocket of the each and every citizens, and then even to the corporate by way of loan. It may look attractive in any normal person who first get to know about this. This is a very good plan as everyone become rich, but this comes with a lot of consequences. This comes with a price called inflation. The next question that comes to everyone's mind is the same operation, why can't we do in India? We can't do in India. The main reason is we are highly dependent on imports. We need foreign exchange to import oils and etc. Hence, we are like a vulnerable economy. Hence, we can't afford to take this kind of risk. Where only developed economies like US, where US currency is considered as a central reserve currency, that's why they're performing this activity. How this is connected to stock market is very simple. Due to COVID, as you all know, the demand didn't pick up. So all middle range people and high level income guys, as their discretionary income were not going towards buying the products, that is goods or services. Instead, they started to have a lot of money and they were searching for the avenues to park their money to get double. So they saw that stock market is one of the area where their prediction is that as the new money has come inside the market, so the company would tend to book higher profit, higher revenue, everything would be higher, EPS. So rather the market price of the share would also rise. So this is the prediction of the most of the investors. Hence, they kept pumping in the money in India. That is institutional investors, where they would be borrowing at very cheap rate and they would be pumping inside India. Just take a look at this interest rate chart. This is US economy interest rate chart, where if you see the interest rate is between around 6% in 2010, and it fall to around 0.15%, and it was keep rising from 2015 to 20, and there was a sudden correction due to this COVID. Right now it is almost 0%. So FIs, what they do is they borrow money at very cheaper rate, and they tend to invest in the emerging markets like India, China, Africa, etc. That's why you see a major trend, that is the market has been soaring high. Even in US the market is soaring high. So where it is all going to end? So what is its consequence that I said before? As the new money is floated inside the economy, this would give rise to inflation. Yes, inflation means that is more number of money is now fetching towards very few or same level of goods and services. So this would rather increase the price of the goods or services than a volume of goods or services that is produced in the economy. To understand it better, even if you see our company's financials, their profit, sales, etc. is rising not because they have increased their volume of sales or production. Instead, the price that they were selling, the price that they were quoting for the goods or services, it has doubled, at least due to this COVID. So even as a common man, we would be experiencing that the petrol price is hitting all-time high, right? So month on month it's keep rising, and even the slowly the inflation is moving towards common commodities that we do use on regular basis, like essential commodities. Once this inflation goes out of hand, then we tend to enter into a technical stage called hyperinflationary stage. There the government has no other choice to recall all its operation, whatever that they have done, that is the recall the money that they have floated inside the economy. They do this operation by way of a function called taper tantrum that they do in US, that is quite opposite to quantitative easing that I explained before, and in RBI, that in India we do reverse repo. Just take a look at the Fed annual results, and then what they have committed in this result. They have said till 2023 they are forecasting that the rate would remain same at 0%, and thereafter they would see if it is required they would increase, right? For that very news, on the day the stock market corrected hugely, and then again it came back to the normal. Now RBI, even in the recent annual report, they say that RBI raises concern over bubble in the equity market. So they feel that there's a bubble. After looking at all this, now answer this question to yourself: whether this bullish trend is there to stay in the long term? Any rational person would say no, right? Now let's get into the second mistake that most of the retail investors do commit, is that before making investing decisions, they do rely a lot on newspaper and YouTube videos, right? There would be a fancy tagline in YouTube as well as in newspaper: Warren Buffett invested in the stock. Why not you? Rakesh Jhunjhunwala took a bought position, took a sell position in all the stocks. Why can't you do the same? If you do the same, you would also be like him. So these are all like a general fancy taglines that is floating across the public media, and retail investors do fall prey for it. Okay, these are very cheap marketing techniques, right? These are used widely by YouTubers, etc. Ask this question to yourself: if you have joined in a new organization, how long will it take for you to understand your specific role? And how long will it take for you to understand the entire operation of the company that you were employed in? For a super smart person, at least will it take 1 year? Then how it is logical enough to believe that you can understand the company's underlying business and its financial results just by looking at 10 minutes YouTube video? Practically it is impossible, right? So if you are doing that, just know that you are just betting, right? It is not proper investing decision. It is just you are purely betting on your money. And IPO, what to say about it? It is just has become a new lottery ticket in today's market scenario. If you have observed in the IPO, more than fresh issue, right? Offer for sale, that is promoter, they are exiting their stake by selling their shares to you, and they are replacing in form of money, that is they are collecting money from you If they feel that the business or business in which they operate has a good fortune, why they have to sell the stake to you? Please observe that. So this is the time where most of the people are trying to book profit, trying to exit, or trying to, like, this is what would happen. This is what we generally say in stock market. Once you get a snake, right, throw it to some other guys. So it's a kind of a alarming stage. So be careful and don't just blindly invest in uh, IPO expecting like good gray market premium, good listing gain, etc. It may not turn around as you think. In just a matter of 10 days, they would say GMP has increased by 20%, now it is 30%. You didn't see today, it is fall by 10% because of economic scenario. Instead of following these YouTubers and newspaper, please take some time, invest your time and effort in reading the financial statements, or you can even take a look at their financial earnings call that they come out with on quarterly basis, AGM on annual basis. So that would be like half an hour to 1 hour video where it would be directly, where you can directly see the face of the directors, managements, and you can even ask the questions if you want, like calling them, and you can even ask. That's how the things are done. So rather than looking at the source where you feel that is more reliable, there are certain places where you can find direct access to the facts and facts of the companies and the market. Don't fall prey to the opinion of the experts. There are no one called as an experts. They themselves will call experts and they would say I'm the great, I'm the great in everything. Third mistake is following FII and trader strategy. Few investors go one step ahead. They would tend to follow what FII does, what trader does. This is a sure shot way to fail. Please remember, FII and traders' money are the hottest money. It would be keep rushing from here and there. For 1 month it would be there in India, for another month it would be there in China, for another month it would be there in South Africa. Only in these emerging countries they would feel that the interest rate is high in those markets, so let's borrow for a cheap rate and let's invest in those countries, right? Even if you take your example, say you have taken a position in XYZ company, what you would discuss with your friend, you would say, I have taken position, this looks attractive, you can also take. Why you are doing the same thing? Because you want more of the investors to participate in that so that the price would go high. The same thing, same strategy is followed by FI and traders also. So if you see most of the brokers, they would come out with 3 months target call, 6 months target call, or sell strategy, buy strategy, different type of strategy that they would come out with. All these are cheap marketing techniques. Ultimately, following all this price target, who is going to benefit from it? It is broker, not you. Because they want you to keep trading so that they can make commission from each position, right? Whether you make profit or not, whether both buyers or sellers, whether they make profit or not, they will be definitely earning commission on it. This is a win-lose strategy. Please don't involve in this. And just take a look at this data where I pulled out from CDSL website, that is our central depository where they keep the records of all the demat accounts. So if you see between 2017 to 2020, the number of accounts has been increased by 2 times, 1.23 to 212 crores, 2.12 crores. And then if you see in the last 1 year, it has been doubled, right? So it means there is an increasing participation in the stock market, and this is also one of the factors that we could say the price is soaring high. And then fourth mistake, subscribing to fancy mutual fund scheme. Mutual fund is a good type of investments, but only if you stick with 1 or 2 schemes, it would give you a good amount of result. Going for a fancy name like giving 100% return, or I would be investing in different geographies so as to diversify your risk, or retirement scheme, or education scheme, ESG scheme, all those things are just marketing gimmick once again. So please, if you observe in the last 1 year, the number of new fund offers that mutual fund has come out is so heavy, right? So they are even asking you to please subscribe so as to protect you against the inflation. All these things would be great to listen at this moment, but after 5 years or 6 years, if you see, your wealth would have been eroded. So mutual funds, they are doing this so that they can earn a commission like 2% on like a AMC fee on the investments that you make. So that is again a win-lose situation. Don't get too much diversified in terms of mutual fund. Instead, you can go for an index fund. That is the only true source of making passive investments. There's no other proper passive investment tool is there in the market. Even Warren Buffett has suggested to do the same. And let's get into the last one. This is the most common mistake that most of employee categories of retail investor does. That is, they believe that the stock market is the only next best alternative that they have to make money after employment. Even I have observed that in most of the companies, few guys who are in accounts department, they won't have much of the work. Once the work is over, they would start opening the demat account, they would start trading, and then they would keep discussing for the whole day. At the end of the day, they would go home by making so much loss. So just know this: stock market can maximum be used to as a tool to protect your inflation. That is, to protect your money from the inflation risk, nothing else. So if you are enterprising investor and if you want to make a money double, yes, you can do, but it comes with a lot of consequence. You should be well aware about all those things. You ask this to yourself. You want to protect yourself from risk of losing job or from single source of income. Hence, you are finding alternative, which is very healthy thought. But entering stock market, which is way higher risk than your own employment or business, is that a right choice? Okay, so most of the retail investors, they are feared that their savings would be eroded by because of inflations, and they want to protect against inflations. Hence, they are entering into the stock market. Just take a look at this diagram. This gives the CPI index, that is consumer price index, which is far equivalent to the price that we pay on a year-to-year basis on the common commodities that we use. But you can have a buffer, say 2% on it, and you can say now the current CPI that recently released by RBI is around 6.5%, and you can say it is around 8.5% is the actual rate. So just keep this number in your mind and just try to match your portfolio return to this equivalent so that your money would be safe. Hoping for a whooping 2 times or 3 times return, don't lose your wealth to that same extent. Okay, at the end of this video, I would strongly suggest you to go through this book called Intelligent Investor by Benjamin Graham. This is the Bible for investors and first ever book read by Warren Buffett. This book won't give you a fancy strategy so as to double your money, but instead it will give you the whole whole knowledge about the financial world, how you can better tweak your emotions as the situations unfold. So all those emotional intelligence that is most required for a investor, that is well narrated in this book. I would like to end this video with this quote which I saw in that book, which is very interesting, and even the most important thing that every retail investor should keep in their mind is this: all of a human unhappiness comes from one single thing, not knowing how to remain at rest in a single room. Right? So you have to stay very patient in order to create wealth in the stock market. It can't be done overnight or over a month. Please be safe, play safe with the stock market. Thank you. Let's meet in the next video.